Well, everybody's clicking on the jobless numbers, so they haven't come down yet because the computers are all tied up. But let's do non-farm productivity comes in much better than expected, up 3.7%. That's after a 2.1% decline in the first quarter. Unit labor costs, therefore, fall. They rise just 1.6%, down from a 4.2% increase in the first quarter of the year. Still waiting on the jobless claims numbers to come in here. They switched to this all distribution by computer, so everybody clicking at the same time. Or it could be that, they're not. The Department of Labor's computer is filing for something.
For filing for something else and having a bit of an issue. Just as we take a look, though, at the non-farm productivity, there is a question about what higher productivity will do to some of these costs going forward, as well as just in general employment.
Well, the productivity numbers are key for the Fed because we've seen average hourly earnings rise significantly as productivity has fallen, so it costs more to make less. And if productivity is rising, then that brings down the danger of the wages, and people can make more money without the Fed having a problem. Now, here's the jobless claims numbers. 227, that's from an unrevised 221 the week before. The ongoing continuing claims, 1,700,000, that's up from 1,679. So a slight increase in continuing claims and a slight increase in initial jobless claims, basically telling you that nothing has changed in the labor market as far as the layoffs business goes. We're still at extremely low levels, and the Fed is going to look at that and say things are still pretty tight.
Just quickly, how much in this newly data-dependent central bank world does this sort of underscore this feeling that this move in the bond market could continue, that there is sort of protracted strength that could fuel inflation, or does it not really tell us anything?
I don't think it tells us as much as people might want it to think. Certainly a lot of this was driven by the increase in supply that we saw, and the fact that we've had people sort of in the bond market like a coiled spring with the inverted yield curve waiting for some signal that things are going to turn terrible, and so you get this brief overreaction. I think tomorrow will be much more telling when we get the jobs numbers. Then you have something really to hold on to. One interesting thing, just crossing the wire a short time ago, Tom Barkin, the Richmond Fed president, said, yes, we're going to have a slowdown and we'll have a recession someday, but it doesn't look imminent. And he made a very interesting point, and that is that this recession has been called for so long, and we all joke about that companies have prepared for it in ways they don't usually, because a recession usually comes on as a shock. And in this case, they have reduced their inventories, they're streamlining costs, and they're holding on to workers without maybe hiring more. So if we do have a recession, it could be short and shallow, he says.